At first glance, global debt feels abstract, a number too large to picture, too distant to matter. Trillions here, trillions there, a figure mentioned in reports, ignored by daily life. But the moment you try to imagine paying it all back, the illusion shatters. Today, the world owes more than $300 trillion in debt. Governments, corporations, households, banks, hidden liabilities, off-balance sheet promises, pensions, derivatives, obligations stacked on obligations. That number is not a mistake. It is not a typo. It is not an exaggeration. It is larger than the combined annual output of every country on Earth, several times over. To understand the scale, imagine every worker on the planet spending every dollar they earn, without eating, without shelter, without healthcare, without education, and still failing to pay it off. Global debt is no longer something to be repaid. It is something to be maintained. Most people assume debt works like personal loans: borrow, repay, finish. But that model collapses at the scale of nations. Governments don't pay off debt. They roll it over. They issue new debt to repay old debt. The system survives not through repayment, but through continuity. This is the first illusion that must be broken. Because if every country suddenly decided to do the responsible thing, to stop borrowing and start paying, the system wouldn't heal. It would implode. Why? Because debt is not just a burden. It is the fuel of the modern economy. Every bond issued becomes someone else's asset. Every loan becomes someone else's income. Every interest payment keeps banks, pensions, insurers, and governments alive. Remove the debt, and you remove the structure holding everything together. This is why the world's debt keeps growing faster than its economy. Growth requires borrowing. Stability requires borrowing. Political survival requires borrowing. And once borrowing becomes essential, repayment becomes dangerous. The uncomfortable truth is this: there is not enough money in existence to repay global debt. Not digitally, not physically, not theoretically. Because most money is created as debt. When debt disappears, so does the money tied to it. And that means attempting to repay all global debt wouldn't make the world richer. It would make money vanish. And when money vanishes, the real collapse begins. Because the question isn't whether the world should pay its debt. The question is what happens the moment it tries. The moment the world decides to pay back all its debt, the first reaction isn't relief. It's panic. Governments announce emergency measures. Finance ministries scramble. Central banks stop speaking in calm language and start issuing warnings. Because paying debt requires cash. And cash, suddenly, becomes the rarest asset on Earth. The first thing that happens is a global dash for liquidity. Countries rush to collect taxes early. Corporations slash spending and hoard cash. Banks tighten lending overnight. Credit lines freeze. Loans that were once automatic become impossible to renew. Even healthy businesses find themselves gasping for money. Why? Because debt repayment drains money out of the system faster than it can be replaced. Every dollar used to pay debt is a dollar no longer circulating. It doesn't get spent. It doesn't get invested. It doesn't create jobs. It disappears into balance sheets, extinguishing the money that once powered the economy. And the scramble doesn't stay orderly for long. Bond markets seize first. Governments try to sell assets to raise funds, but everyone is selling at the same time. Prices collapse. Interest rates spike violently. What was once considered safe government debt suddenly becomes unstable, not because governments are failing, but because everyone is trying to exit simultaneously. Banks feel it next. They were built to manage rolling debt, not mass repayment. Deposits shrink as borrowers withdraw cash to settle obligations. Reserves evaporate. Interbank lending halts. Institutions that looked solid days earlier are suddenly illiquid. Then comes the corporate shock. Companies cancel expansion plans. Layoffs begin immediately. Projects are shelved. Supply chains fracture. Businesses that depended on cheap credit for inventory, payroll, or growth simply stop functioning. Even households feel it. Mortgages are repaid, and banks lose future interest income. Credit cards are closed. Auto loans vanish. consumption drops off a cliff. The economy doesn't slow down, it locks up. This is the great paradox of debt repayment. The more aggressively everyone tries to act responsibly, the faster the system destabilizes. Because modern economies are not built for debt elimination. They are built for debt circulation. Debt connects savers to borrowers, pensions to governments, banks to markets, workers to wages. Remove it suddenly, and those connections snap. The first move, the attempt to pay, doesn't clean the system. It drains it. And once liquidity vanishes, something far more dangerous follows. Money itself begins to disappear from the global economy. That is when the real collapse starts. What most people don't realize is that paying off debt doesn't just reduce obligations, it destroys money. In the modern financial system, money is not primarily printed by governments. It is created by banks when they issue loans. Every mortgage, business loan, and government bond injects new money into the economy. And when that debt is repaid, that money is erased. So when the world tries to pay back all its debt at once, money doesn't circulate. It disappears. Banks receive repayments, close loan accounts, and extinguish the credit that once existed. The deposits shrink. The balance sheets contract. The money supply collapses, not gradually, but violently. This is called a liquidity collapse. Suddenly, there isn't enough money to conduct basic economic activity. Businesses can't access cash for payroll. Governments can't fund daily operations. Trade slows because buyers don't have currency, even if goods exist. The world doesn't run out of resources. It runs out of liquidity. Prices begin to fall, not because things are cheaper, but because no one can buy them. Deflation spreads across markets. Assets lose value rapidly. Real estate collapses. Stocks plunge. Commodities stall. And deflation is far more dangerous than inflation. When prices fall, people stop spending. They wait. They hoard cash. They delay investment. The economy freezes into paralysis. Banks respond by becoming even more defensive. They stop lending entirely. Cash becomes locked inside financial institutions, inaccessible to the real economy. What little money exists gets trapped at the top, while businesses and households below suffocate. Pensions feel it next. Retirement systems depend on steady returns from bonds and markets. As debt disappears and markets crash, those returns vanish. Pension funds face massive shortfalls overnight. Promises made decades earlier suddenly become impossible to keep. International trade collapses too. Global commerce runs on credit, letters of credit, trade financing, currency swaps. When liquidity dries up, ships stop moving, factories stop exporting, ports slow to a crawl. This is the nightmare scenario central banks fear more than anything else, because once liquidity collapses, traditional tools stop working. Lowering interest rates doesn't help when no one is borrowing. Printing money doesn't restore trust when confidence is gone. The system enters a downward spiral where every attempt to fix it makes it worse. And this is the cruel irony. The act of trying to be financially responsible, paying off debt, becomes the trigger for the deepest economic breakdown imaginable. The system doesn't survive because debt is immoral. It survives because debt is structural. And once liquidity vanishes, the next failure isn't abstract or financial. It's institutional. Because when banks and markets collapse together, the shock moves from balance sheets to people's lives. When liquidity collapses, banks don't fail loudly at first. They fail quietly. Screens still glow. Branches stay open. Statements still update. But beneath the surface, the system is breaking. Banks are not vaults full of cash. They are intermediaries built on confidence. Confidence that deposits won't be withdrawn all at once. Confidence that loans will roll over. Confidence that markets will remain liquid. When everyone tries to pay debt and withdraw cash simultaneously, that confidence vanishes. Depositors rush to secure their money. Institutions restrict withdrawals. Payment delays appear. Transfers slow. ATMs run dry. This isn't a technical failure. It's a psychological one. Once people believe their money may not be available tomorrow, panic spreads faster than any virus. One rumor is enough. One frozen account. one failed transfer. Banks respond by protecting themselves. They halt lending entirely. They liquidate assets at any price. They dump bonds, stocks, and loans into collapsing markets. And markets respond with violence. Stock indices plunge not because companies are suddenly worthless, but because forced selling overwhelms buyers. Prices fall through historical supports. Circuit breakers trigger. Trading halts. Reopens. Halts again. Bond markets, once the safest corner of finance, fracture next. Government bonds spike in yield as everyone tries to sell at the same time. The asset meant to represent stability becomes a source of instability. Pension funds implode. They were designed to collect interest over decades, not to survive sudden debt extinction. As bond values crash and equity markets collapse, pension deficits explode. Retirements promised for generations evaporate in months. Insurance companies follow. They relied on predictable returns from debt markets. With those markets broken, liabilities exceed assets. Guarantees become meaningless. The global financial system enters a feedback loop. Selling creates falling prices. Falling prices force more selling. More selling destroys confidence. Destroyed confidence kills liquidity. And once confidence is gone, even healthy institutions are pulled under. This is why governments fear bank runs more than recessions, more than inflation, more than debt itself. Because banking failure doesn't just destroy wealth, it destroys trust. Trust that savings are safe. Trust that markets function. Trust that tomorrow will look like today. When that trust collapses, the crisis moves beyond finance. It becomes political, social, explosive. And at that point, governments face a brutal reality. They must choose between letting the system collapse or stepping in with force. Because once banks fail and markets panic, the next shock hits society itself through unemployment, austerity, and unrest. And that is where the true cost of repayment is finally felt. When banks fail and markets collapse, governments are the last line of defense. And when the world tries to pay back all its debt at once, that line begins to crack. Governments rely on debt not just to grow, but to function. Salaries, pensions, healthcare, welfare, infrastructure, defense. All of it depends on borrowing that is rolled forward over time. When debt disappears and liquidity dries up, governments don't become healthier. They become paralyzed. Tax revenues collapse first. Businesses close. Unemployment surges. Consumption falls. With fewer people working and spending, governments collect less money precisely when they need more. Budgets implode. Deficits explode, not because of spending, but because income vanishes. So governments respond the only way they can. Austerity. Public services are cut. Subsidies disappear. Infrastructure projects stop. Healthcare budgets shrink. Education funding collapses. And the people feel it immediately. Millions lose their jobs as companies fail. Pensions are reduced or frozen. Savings evaporate with collapsing banks. Social safety nets tear under pressure. This is where the crisis leaves spreadsheets and enters real life. Families who lived paycheck to paycheck fall into desperation. Middle classes slide downward. Young people see their future erased before it begins. Elderly citizens watch lifetime promises break. Social order weakens. Protests erupt. Strikes spread. Trust in institutions dissolves. Political extremism rises. Governments lose legitimacy not because they are evil, but because they are powerless. They cannot spend without borrowing. They cannot borrow because the system is broken. They cannot print without destroying confidence further. Every option makes the crisis worse. History shows what comes next. Borders close. Capital controls appear. Withdrawals are limited. Currencies fracture. Emergency powers expand. The social contract, the invisible agreement that citizens obey laws in exchange for stability, begins to unravel. This is why debt repayment on a global scale is not a moral reset. It is a social shockwave. Debt quietly holds together modern civilization by smoothing cycles, delaying pain, and distributing time. Remove it all at once and the pain doesn't disappear. It concentrates. The final truth is uncomfortable. Modern societies are not designed to function without debt. They are designed to manage it indefinitely. And once governments break under the pressure of repayment, one realization becomes unavoidable. The system was never meant to be paid off. It was meant to be sustained. And understanding that truth changes everything. At the end of this thought experiment, one conclusion becomes impossible to ignore. Debt is not a flaw in the system. Debt is the system. Modern economies are not designed to reach a final balance sheet of zero. They are designed to move forward in time, spreading costs, risks, and growth across generations. Debt is the mechanism that makes that possible. Without debt, there is no modern money. Banks don't simply move existing cash around. They create money by lending. Governments don't wait until they have surplus wealth. They borrow to build infrastructure, fund wars, stabilize crises, and maintain social order. Corporations don't grow from savings alone. They invest future earnings today through credit. Debt is how the future is pulled into the present. And this is why trying to eliminate all debt at once breaks everything. Because when debt disappears, the future disappears with it. Investment stops. Innovation stalls. Long-term projects collapse. The economy loses its ability to plan beyond tomorrow. This is the part most people misunderstand. Debt is not inherently bad. Uncontrolled debt is dangerous, but zero debt is catastrophic. Healthy systems rely on manageable rolling debt, debt that grows slowly, stays serviceable, and aligns with productivity. The danger isn't borrowing. The danger is pretending debt can be eliminated without consequence. That belief comes from applying household logic to civilization-scale systems. A family should pay off its debts. A nation cannot. Because a nation's debt is someone else's savings, a pension fund's asset, a bank's balance sheet, a worker's future income. Erase it, and you don't cleanse the system. You erase the structure that holds it together. This is why governments always choose inflation over repayment. Why central banks panic over deflation. Why debt jubilees are rare and controlled. Why crises are managed, not resolved. The goal is never to end debt. The goal is to keep it alive without letting it explode. And that is the real secret of modern finance. The world does not survive despite its debt. It survives because debt allows time. Time to grow, adapt, adjust, and delay collapse. Debt is the pressure valve, the shock absorber, the bridge between what exists and what might exist. Trying to pay it all back at once doesn't restore order. It removes the scaffolding holding civilization upright. The uncomfortable truth is this. The system doesn't need debt to be moral. It needs debt to be continuous. And once you understand that, you stop asking when the world will pay off its debt and start asking a far more important question. How long can the system keep balancing it before something breaks?